Hello, everybody. Welcome back to 21st Century Renaissance, and welcome back to another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. It's wonderful to see you all. Thank you so much, as always, for your support, for watching and listening. If you want to get a look at today's article, it is up. It is live on Twitter. You can find it down linked in the comments in the description. If you are viewing this on YouTube, of course, if you're viewing this on Twitter, you've already seen it. It's right at the top of the page. So let's hop into our discussion today, thinking about gearing up for a requel. So there's been a lot of discussion recently, certainly a lot of hype this summer over the idea that GameStop is currently going through a requel, as hinted in a cryptic Roaring Kitty Keith Patrick Gill meme posted to Twitter, I should say X, back in May, and the potential for events leading up to the end of this year and into early next year to possibly mirror certain key events beat for beat, certain price action that took place in 2020, 2021 during this meteoric upward volatility event that shook the market back in early 2021. So we have seen some elements that have looked very familiar to that. Certainly, some of the price action we saw over the summer did look particularly similar in terms of its algorithmic pattern, right? In terms of the measured size of the moves made in the price action this summer during Keith Gill's return to X and to Superstonk, his first appearance on Superstonk for that matter, back in June. We saw some similar patterns in terms of the way the price moved between these two periods. But is it possible that a requel could mean something that has to do a bit more structurally or in terms of buying? Could it mean that our price action heading into the end of the year might mirror something like what we saw take place in 2020? Certainly this upward bull trend we've seen develop since National Cat Day, otherwise known as the Catalyst, around October 29th, has elevated GameStop's prices significantly off the lows that we saw in late August, early August, in September, and in October at below and around $20. So there's some thought that perhaps this might have something to do with some swaps, that these sort of timing these moments might have something mechanically to do with swaps or FTD settlements that has failed to deliver settlements. If you'd like a good breakdown on some of the leading concepts and theories regarding the latest concepts, just this past weekend, Richard Newton did a really excellent two-part video on this. Part one dropped on Saturday, part two dropped on Sunday. I'd really recommend you go check that out. He does a really good job bringing together all the information that he's worked on for about the past 3 years and trying to understand how these cycles, how swaps potentially work. Obviously, it's a very difficult topic, but Richard really fits a lot in under 2 hours between those two videos. So I'd highly recommend you go check that out. Now, today, I'm not going to be talking too much about the swap idea. I'm not going to be talking too much about the mechanics of a requel, but I am going to touch on the idea that if something like this, right, whatever that event may be, if, say, institutions are planning for something like an upward volatility event to take place toward the end of December into January, will we be able to see some of the signs of this, or are we now seeing some of the signs of this as a preparation for such an occurrence? Certainly, in December of 2020, one of the major December event was that Ryan Cohen, now CEO of GameStop as of 2023, increased his stake in the company by 30%, and then in January announced his intention to join the board. If I'm not mistaken, this may have taken place around January 9th, something to look into in terms of that 109 thing, perhaps in Roaring Kitty's most recent post on X. I won't speculate too much on that. I'll have to revisit that idea in a later post. But this, a major event, a major catalyst in the upward price action for GameStop in late December 2020 and in 2021 was that Ryan Cohen significantly increased his position and filed a 13D, an amended 13D, indicating his intent to take action necessary to protect shareholder interests on December 21st. That is, this took place approximately 10 trading days, approximately 10 trading days follow the quarter 3 earnings report. In December 2020, GameStop traded down from a high of about $16 prior to earnings, $16, $17, all the way down to about $10, wherein the following week, the week following the release of the earnings report, for all 5 days, Ryan Cohen sent in buy after buy after buy in order to increase his total stake in the company up to 12.9% at that time. He increased his total number of shares to 9,001,000 pre-split, and this number has been recently given an homage by Keith Gill himself back when he exited his very large call position in June, exercised a part of it in order to bring his total stake in the company up to a post-split adjusted 9,001,000 shares, and then also revealed a 9,001,000 share position in Chewy, which he only recently revealed to have exited at the end of our third quarter via 13G filing on National Cat Day. So could we see something like this week? Could we see if there is some sort of major buying event, if it's from Roaring Kitty, if it's from potentially Ryan Cohen himself? Would he potentially increase his position in the company? This is certainly possible, given that GameStop did not do an at-the-market offering this last quarter, this last earnings report, which GameStop has done for each of the past 2 quarterly earnings reports. This allowed insiders actually as of Friday, including Ryan Cohen himself, to purchase shares. This way, by not doing the at-the-market offering, he can't be accused of lowering the share price in order to get a better entry point for himself and for other insiders. So this does open up a window for him to potentially enter and increase his own position in the company now that his percent stake has been actually surpassed. He is no longer the largest, I should say, RC Ventures is no longer the single largest holder of GameStop stock. I believe it's been replaced by BlackRock by a few percent. I should say by a few percentage points or a few tenths of a percentage point. So this is possible, right? I won't spend this video speculating too much about this, but if it is the case that we see some kind of preparation for an upward volatility event, what would that look like? What would that look like institutionally? What would that look like in the price action? Well, it might be reflected in some outside external buying, kind of pushing the price up. But how are institutions, how is the options market really set up for this right now? Does it differ too much in terms of the structure of market maker hedging, in terms of what we look like technically? What really, independent of these external catalysts, potential bullish catalysts, are we set up for right now? That's the question that I approached in my article for today. Really what we looked at last week, heading into Friday, we did get that Max Payne scenario that I talked about, right? So I spent a fair bit of time on Friday outside of the article, but also in the article as well, talking about market maker hedging throughout the week. Throughout the previous weekend's videos, I talked about market maker hedging. I also talked about the strategy that market makers, for example, Wolverine Trading, which is GameStop's designated market maker, take in order to ensure maximum profitability in their positions. Now, it seems likely, right, because as a designated market maker, there is an extreme amount of profit to be extracted, especially from a stock with high implied volatility like GameStop. There is an extremely high amount of profit to be extracted from selling short calls, especially short options in general, but especially short calls, since GameStop, basically since about mid-April, has gone back to a predominantly call trading stock. So calls are definitely predominant in our OI. It is a popular retail stock. Because it is a popular retail stock, retail traders, as I posted last Friday, a study from Beckmeyer et al. Back from just last year, retail traders in very large quantities, for example, in SPY, in excess of 75% of retail traders trade exclusively 0 days to expiry options. Now on SPY, it's mixed between puts and calls. It's much more balanced. Puts and calls are much more balanced. In fact, recently there's been sort of an imbalance in terms of puts. But on GameStop, it's certainly in favor of calls. And although 0 days to expiry options are not available every day, short-dated options certainly are, and short-dated calls certainly are. And especially now that we've moved into this bullish uptrend period, which we've been sustaining for about the past 6 weeks, call volumes are high, and there's certainly even more incentive for market makers to work potentially through their investment arms to potentially adjust the price, either as market makers or through their relationships with prime brokerages by adjusting implied volatility values, or through outright rerouting of order flow, or through direct shorting at key levels within the landscape. Now, there were definitely a lot of shares that came available to borrow, seemingly out of nowhere. This is likely per Richard Newton's discussion. He often talks about this. He's been tracking the ways that institutions create shares available to be borrowed, create lendable shares through the redemption creation cycles on ETFs that have GameStop. In particular, just recently, he found a few ETFs that he had not been tracking that do in fact have a pretty decent weighting of GameStop within it. So there's a lot of potential to be able to do this, to create shares by packaging or repackaging shares of these ETFs, these custom packaging of shares. And this way, right, you can sort of create shortable shares out of nowhere by doing this. We did see some moments of conspicuous shorting. I wouldn't say egregious, but our movement certainly out of the open, right? There was this, our movement out of the open in particular looked to have been driven by shorting. We do see some volume candles in here that are indicative of heavy shorting, such as this one around here at about 11 a.m., this very large candle of about 100,000 volume. Certainly right off the open, we have some very large candles that look to have been certainly bearish volume, certainly a lot of selling. And largely I've spoken about how GameStop in particular tends to have very large call accumulations, in particular long call accumulations at these sort of psychological round numbers. So $20, $25, $25, $30. $30 for some time has been a very popular strike for buying calls. It, for many weeks now, has functioned as our call gamma call wall. That means it acts often as both a sort of target in moving toward it, but also as a lid. Market maker gamma hedging suppresses price movements above this level. And we have not seen a weekly close at or above $30 since August of 2022. So that's quite a lot of consecutive weeks without seeing a close above a post-split adjusted $30, current value $30. What this means is very, very large numbers of calls frequently are opened, typically long, right? Retail traders, the most popular orientation for retail, for typical options buyers, is long calls. Retail I just took, right, if you take a look on my X profile today, I just did a bit of a survey of this, right? Two-thirds of those who follow me, people who, traders, mostly retail, right? Mostly, I doubt very many super high profile pro traders are following what I have to say. Not being an expert, right? Having maybe some inside looks into how all this works already. But approximately two-thirds of respondents to this particular poll, decent sample size, got up to about around 100 respondents, had never sold a call in their life, had never used this type of trade ever, or about 15 to 17% had only done so sometimes, only do so sometimes, do not do so regularly, and only about 15 to 18% do so regularly. So typically these calls, when they're being sold, they're being mostly written by dealers, meaning that the dealers are the short party, and the options market traders in the options market, especially retail traders, are the long party. What this results in, most usually, based on the tools that market makers have at their disposal, is we see a very significant amount of calls expire out of the money. Oops. My window is going all over the place. Here we go. Right, so I just broke down the basic numbers here in the article, right? So we had nearly 140,000 calls expire out of the money on Friday. 140,000. So around 93% of the calls sold, calls opened, I should say, that were open as of expiry on Friday expired out of the money. And approximately 80% of all open puts expired out of the money. So we finished right on top of max pain, right? We finished, in the after hours. We closed the day 1 cent below max pain, theoretical ideal max pain, and we, in the after hours, I think the after hours period ended with the price at about $28.02. So, those whatever calls were technically in the money by 2 cents by close were in the money by, say, something like less than a net less than a cent if they were closed, or by about a cent. So market makers are certainly taking home a very hefty profit on say even those $28 calls, and certainly, right, a good portion of even those in the money calls, fewer than 10,000 calls expired in the money. A fair portion of those still expired, right? If they were opened close to expiry and still expired, probably at a loss for anyone who opened them, with the exception of a few moments over the past couple weeks. If you open them decently far enough back, then you likely still made a profit, several months ago, say, maybe back in mid-October, you made a profit, or say early November. Later November, you probably didn't make a profit. You had a couple moments basically back in this like $26 retrace area around earnings where you might have made a profit, where IV kind of cooled off a little bit. With some of the in-the-money calls, you might have made a profit, since we did have some decent intrinsic value appreciation with respect to the underlying. Having a $28 finish, say if you had you bought a $23 call or something like that. There weren't that many of those, but right. So over 90% of all of Friday's open interest expired out of the money. So this was a textbook case of dealers making sure, market makers making sure that that they made their profit. Right, we saw this kind of bounce off of our $28 call wall, this kind of historic price support, which lined up with our VWAP support line, 2 standard deviations below the volume weighted average price. And as I said, we did have this potential in the gamma structure. Our gamma structure, basically from $28 up to $33, we did have a lot of call gamma built up, where the right amount of bullish volume could have sent us on a bit of a run. But again, that was very volume dependent and catalyst dependent. If there was some sort of catalyst, if Rory Kitty tweeted something, or who knows, the algorithms may have pumped the price. But we really didn't have any inclination from him that we were going to see something like that. So I was very cautious about playing anything like that, certainly not encouraging long call bets on that basis. But as you can see, some buyers on this bounce off that $28 call gamma position was served as a hedging supported floor on the price for the day. Pushed us, right, some buying, some concentrated options buying in the bullish direction did push us up into our upper channel, but basically there was not really much conviction in the market to push us past essentially what was our opening price. So up from that level to the opening price, right, there was, okay, is it going to go, right? We see this hesitation. Okay, is it going to go a little sell-off? Oh, move back to the 200-minute moving average. Oh, maybe we're going to make our way up there again. No, right? So indecision, stalling, didn't even quite make it back up to that $29 resistance, basically just up to the opening price. Kind of got, I don't know, something of a weak call and I should say cup and handle sort of a shape, but then, right, options buyers kind of threw in the towel and just let charm. So charm is delta decay over time set in. Negative charm kind of carried the price down. We got a little bit of additional shorting in here to make sure that the price really got pushed as close to $28 as possible. I think basically what we were seeing in the after hours was something like a covering event, something like shorts who wanted to see the price cover, like close at sub $28 at $27.99. Didn't cover their positions until the after hours, when it would be, there'd be less of a risk, I guess, of it upsetting the options market, upsetting sort of the hedging dynamics of the options of the lit market, I should say. Okay, so that's what we were looking at on Friday's trading, right? Overall volume was pretty low. I think we had around slightly over 6 million total shares traded. Right, our options volume pretty low, very heavily skewed towards bearish premium. Definitely riding a lot of those options trades, those bearish options trades, I should say. Pretty decent volume of premium spent at the mid as well. So pretty neutral, pretty bearish day. I mean, the options market reflected that. I think a lot of people came out expecting what we got, right? We had that one chance early. There was this test of, all right, we'll get this reversal within the channel, but when we kind of stuck around our VWAP limits, not really any other additional conviction to see if that would get pushed farther. So yeah, market makers move out of the week. They finish yet another week with millions upon millions of dollars of premiums straight in their pocket. So that's how this works, right? That's how this game works. That's what we do. Okay, so what are we looking at in terms of technicals this week? As you can see, we're still in this sort of dual regression channel area. We're still largely conforming to our bullish uptrend after these two saves, both by Roaring Kitty and by bullish earnings reaction. We've been trading in this the lower half of this bullish regression channel with bearish attempts to kind of push us out of there. It looks basically from our technicals that given that this bullish regression channel hasn't quite flattened out yet, that what it looked to me like what would be most likely is over the next 5 trading days, we kind of move sideways, some potential maybe for a test of our nearest, extra channel technical support, maybe, at some point when this bullish sub-channel sort of flattens out, but then comes to align with this 204-hour moving average, we could see this sort of a move towards some consolidation there into December OPEX, especially because we have a lower max pain point this week. We'd see, options implied volatility flatten out. Some slightly lower price levels are possible. Now, if the options market, if institutions, if smart money is also preparing for something like a Requel, now, how could they be doing that, right? If they also have knowledge, which it seems they did back in May and June, if they have knowledge of whatever mechanical elements, whatever market mechanics are driving this upward volatility that Keith Gill, that Roaring Kitty has been pointing out to us with his cryptic tweets, or pointing out to the internet, attempting to point out, right? It's clearly not him driving this price action. He is able to draw attention to these moments when he expects this price action to occur, which alludes to an underlying or several underlying market mechanical structures maybe that shouldn't exist, that do exist, that are driving this upward volatility. So if smart money, if something is coming, right? Let's say something is coming. Let's say something like swaps are expiring. There's a lot of notional swap values supposedly coming due in December. Who knows what that really means? Again, I'm not an expert in these mechanics, so I couldn't say. But let's take as a given that something is going to happen. What would we see? What would institutions be doing with respect to that upcoming catalyst? Well, one, they would likely know about it, right? If someone like, if Keith Gill knows about this, there are definitely institutions that know about this and that strategize trades around planning for these types of catalysts. So if something like that is coming, then institutions are definitely preparing for it, if that's the case. Okay, then what if something were about to happen, right? We're about to line up, let's say poetically, or we're about to rhyme in terms of time with something like Ryan Cohen's second round of buying, his amended 13D filing. If something like that is indeed going to occur, if we are setting up for something like that this week, and this alludes to some other type of mechanical occurrence that will pop up in around the same time frame, as an institution, what would I want to do? What would I want to see? How would I want to nudge the price and the structure to reflect, to present me with the optimal opportunity to profit off of that? Well, number one, I would already be pretty much set up for it, and we did see a lot of institutions prepare for that back in September, right, with these institutional 13F filings, large accumulations from places like Renaissance Technologies, proprietary trading firms that bought very large numbers of GameStop shares potentially to, was it just them preparing for, is this like a T35 covering event, a fail to deliver event, something like that for, for their buy-ins in September or August? Who knows? Like I said, I won't speculate. But if I were looking to say profit optimally from the options market off of some incoming upward volatility, what would I want the next next 5 days to look like? I would want it to look like IV flattening out, maybe trade down a little bit to enter into some long positions in the options market, long calls potentially, for as attractive of a price, as attractive of a valuation as I could. So we do see that potential in the technicals, and we do see the potential for something of a downward move, not as deep of a downward move as potentially was on the table about 2 weeks ago or even last week, based on how much higher we see that 204-hour moving average ticking up. But it is definitely on the table. Something like a move down to in the next 5 days, something like $26, $26.50 maybe in there, to see the lower bound maybe of this bullish, this bearish regression sub channel maybe intersect with the 204-hour moving average before the 204-hour moving average moves into line with our, resuming something like our bullish regression channel, something like that, right? That seems possible in technicals, and we do see these same sort of levels pop up in our options data. Also earlier today, we did see this lower bound of our bullish regression channel respected as a technical support in pre-market trading. I mean, that's not hugely meaningful, but it does mean that traders at this point, institutional traders, like professional traders, people who are not retail traders, did look at this bound and did treat this bound as though it had predictive validity, as though it was a significant navigational marker. So we might see that continue to hold up. We might start the early part of the week trading, up above something like 28. We might see something like that. We might, I don't know, maybe we move back to this pre-market level as a low. We'll see, right? It's hard to speculate too much, but certainly that move downward is on the table. If we look at options changes, OI changes, things like max pain, right, we do continue to see in the short term some outsized accumulation of put open interest in this lower range. So 28 down to, we have a very large position at 24. I think 24, right, this 24 position is something like what was possible pre-earnings, before we had a bullish reaction to earnings, before we had Roaring Kitty kind of step in with a tweet to, I don't know, trigger some kind of algorithmic reaction, right? We saw that pop up, and actually, right, we saw that positions contract into last week. Some traders decided, you know what, that's enough. This is a losing position. I'm going to take my losses on this. I'm going to pack this up. Up the chain though, right? We did see quite a bit of. We saw some decent OI expansion at 27 for the following. Wait, where are we here? That's not what I want. I don't think I had an image for this. In any case, for the following week, we did have some put sales at 25. So, a bullish bet, certainly. We do have a lot of support at $25 in our gamma data that we'll take a look at in a second. And in terms of max pain, right, we actually did see max pain move up to 25.50 for this week. So I could see that continuing to move up a bit to $26, $26.50. We do have a significant number more in the money calls. We have quite a few at $25. That is a very strong position. That being said, obviously market makers are going to want to close as close as they can to that. Maybe if they can stimulate some downside volatility early, they can draw in some put buyers, even put sellers, but preferentially probably put buyers at some lower strikes, maybe around 25, $26, and use their short orientation towards those puts in order to help make something like $26 or $26.50, which aligns a lot more closely with that technical support level at the 204-hour moving average more closely. I could see something like that happen. We see it's a little early for December 27th and January 3rd expiries, but we see our max pain points kind of forming up around that level too. So yeah, there is a bit of, I would say, weak, like barely kind of bearish, but somewhat sideways potential impetus forming up both technically and in our options market in our OI data. We don't quite seem to have that. We are definitely a lot more bullishly structured heading into the middle of January. So it does look like, right, we do have this kind of vague, faint picture of, well, some bearishness, not crazy downside bearishness, but sort of mid-20s, mid-upper 20s, maybe continued correction for a week, maybe past December OPEX a little bit. But certainly it looks like we're coming to a head here, kind of late December in terms of the bearishness. And as that bearish regression channel, that sub channel, sort of as we continue to extend it, it's going to flatten out into a neutral character. And I think once we get to that, okay, it's consolidated, right? We've got lower highs, but higher lows. Then certainly if something comes in at that moment, that'll also be technically configured to support a move to the upside that the options market might feel confident in supporting and entering for a sort of longer term bullish upswing, something back into that sort of upper 30s areas, maybe over the course of a month, maybe by mid-January. I won't speculate too much on that, but we do see that potential. We're back in terms of our daily put to call gamma exposure ratios. We're looking a lot like we did last week. So that's saying, okay, we're, right now our trading is such that in terms of options flows, we look something like we looked like last week. So maybe we take out some of that up and down craziness with respect to earnings, and we trade basically, with the exception of earnings. We were pretty flat last week, right? Our numbers really corrected significantly lower. I think we logged something like 3 days with our total volume, in sort of under 6.5 million or around 6.5 million. That's pretty low for what we've seen for most of November. It's certainly higher from what we saw, say, towards the end of October, but that does prefigure to have this kind of IV depreciating effect. Maybe not crazy, right? It's not going to take us back to those October year-to-date lows, but can take off a few percentage points of IV, can maybe make or incentivize call buying in the options market more broadly to be able to support a bullish trend into January, make that a little bit more appetizing. And if we look at our call gamma exposure overall, we can infer some dynamics in terms of what we're looking at as far as how market makers will respond to certain forces, certain impetus, fourth declension, Latin friends out there. Two different sort of directives, right? So as long as we stay above that $28 gamma position, we are looking at stable trading, likely pinned to a tight range, most likely 28 to 29, but with some potential to kind of move up into the mid 29 to 30 range. That's going to depend on volume. If we stay at a lower volume, I think sort of in the 29.50s is maybe our cap on the week if we stay above 28. If we do get something like, you know, I don't know, some shorting off the open or something, you know, that stays particularly heavy. I think last time I checked, there was something like 1 million shares to borrow. So not crazy, but there's some firepower there to move us down. If we can get down to 27, then we will get some pull down from this 26.50 position where we do have a bit of net put gamma accumulation. It's not crazy, but we hit a speed bump really not until about 26. So if we could get bearish sentiment, if we move into this tight sort of 26 to 28 neutral, slightly bearish zone, we kind of slip down a bit into 26, into 26.50. The sooner we do that in the week, the lower we'll go, right? Because the longer we take to do that, the higher the 204-hour moving average is gonna move up. It's been moving up at about the rate of $1 a week, $1 per 5 trading days. So yeah, if we move down sort of harder or faster today, tomorrow, we would see something like we could see something as deep as $26, maybe even slightly below $26 if bears are really getting aggressive. But as you can see, all like way down below us at $25, we have a really large call gamma position at 25. That's going to be difficult, right? That's going to be hard to sell as oh no, this is going to fit. There's strong gamma hedging support at this level. $25 is a big round number. If we saw something like $25 pop up, that would just scream imminent reversal, like big bounce. I mean, somebody would have to create millions of shares through ETFs really quickly in order to sort of dump us through that, to force us through there. And they leave themselves pretty exposed, especially if there is something like a Requel around the corner. That'd be tough. I would hesitate to take that risk, but you know, that's according to my rudimentary understanding of how market makers and how institutions are potentially controlling the price and how well they're hedged and what they think they can do and accomplish. I'm not seeing evidence for something like a push, even to $25 at this point. I think that's a little bit too far afield given how much call gamma we have accumulated there heading into our OPEX this week. Yeah, as I mentioned too, you can take a look at these bar charts. As we go further out, like, okay, you can still see how many calls are open. Like, we have so much gamma at 30. Like, market makers are so heavily incentivized. Like, keeping the 30s out of the money is so lucrative for them. They will keep trying to do this for as long as they can because it makes them so much money, especially if they're worried about, you know, stuff down the road, right? They want to accumulate money so they can have firepower, you know, down the road, so they can, I don't know, so somebody doesn't get margin called, somebody doesn't, right? They can hedge things better. They can, I don't know, work better in their other positions. They don't maybe have to exit their positions if there is a really crazy, out of control, upward volatility event. It's just, you know, there's more breathing room if something like that does happen. But like, it's so, you know, this is what a call wall looks like. There's so much call gamma. There's even more call gamma now today for this Friday than there was call gamma last week on Friday for Friday. Right, typically we see call gamma at this position peak on the day of expiry. So who knows? You know, this week maybe we see 25,000 calls of open interest by the time we arrive at Friday. So, I really doubt market makers are yet again that we're going to see something like that, especially with Max Payne down in this kind of negative net negative gamma area, even though it's pretty light. Right, but as we sort of bump out a month, right, we don't have this same type of structure, and in fact, we can see just how big that $25 call gamma position is. I mean, market makers, don't get me wrong, market makers would love to drive this out of the money too, especially because our Max Payne is down here around 20. But yeah, that's going to be a question. If they don't know, if they're, I don't know, if the Requel really is dependent maybe on something not mechanical, or not solely dependent on an impending mechanical like swap or FTD thing. I don't know. Maybe market makers do try to, in January, try to force the issue on this $25 position. Again, I think that's going to be hard. It's going to take a long. If they do intend to see that, we're going to see that building up over several weeks. It's going to take some time into January for them to actually sort of move us down in that direction. And even if we do move that way, the options market will open some puts that will make it such that they don't have to push us that far down. But again, I'm not going to speculate that far out at this point. It's, we have a ton of OI. We have a ton of accumulated gamma. It's hard to say between now and the middle of January exactly where we'll be. Certainly, if there is going to be some kind of a Requel thing that happens this week or next week or what have you over the weekend, on Monday, like Ryan Cohen reported on the 21st of December with his modified 13D in 2020. I don't want to get ahead of myself here, so keeping the focus on near expiries. And as we can see, as I talked about last week, as I talked about heading into earnings, that's some pretty substantial IV crush. We're certainly heading down. We'll continue to head down if we trade sideways. We'll certainly continue to head down even faster if we get shorted into this week, if we sort of trend down towards $26 or $25. I don't think we'll get as low as late October, as those October year-to-date lows. But seeing something like we saw maybe late September after earnings is definitely on the board. I think that's definitely a possibility. Depending on how soon we reverse to the upside, we might do something differently. We might not get quite as low in terms of our IV, but it's definitely going to get lower. And certainly if I'm an institution, if I'm smart money that knows something's coming up around the corner, I like seeing that, right? I actually want to encourage that, because if something really big is up around the corner, I want to build out some options positions while IV is low. I want to do them, I want to buy them up for the best value I can. And low IV and downward movement, price depreciation, right, lower intrinsic value. If I know there's going to be this swap event or FTD something coming up in January or coming up in February, whatever it is, then I'm going to want to optimize my entry point on this stuff. So I like this, and I'm going to try to encourage that this week if something doesn't foil me unexpectedly, right? Taking that risk into consideration. So that's what we're looking at this week. Yeah, we'll have to see if we get this Requel scenario. We'll have to see. We'll have to see what happens. It's there's a lot of things to look at this week. I'm certainly looking out for what happens with IV this week. I'm looking at what happens with our price, as I do every day. I'm looking at how we behave with respect to certainly this $28 limit, this $28 call position. I'm looking at how we behave with respect to that 204-hour moving average. That's what my eye is on, and I'm looking at that and potentially additional signs that maybe people are going to start. Maybe smart money starts positioning itself to take advantage of something like a big mechanical induced, market mechanic induced up move that is independent of something like a Ryan Cohen or Roaring Kitty related event. Yeah, so that's what we're looking at this week. That's what I'm looking for this week, right? So overall, thinking, ceteris paribus, we're looking at probably a flat to slightly down week, as I talked about last week. I think Max Payne will move up from where it is at 25.50. So I'm not anticipating a close quite that low. Could happen, but I'm not anticipating that. Something maybe closer to around 26 or 26.50 is definitely on the table as Max Payne moves up. And looking for IV depreciation if we do get that, to see if that incentivizes some bigger players to enter long options positions heading into late December, heading into January in the preparation for something like a Requel. So yeah, so if you want to check this out in deeper detail, go ahead and check out the link in the description below. If you're watching this on YouTube, check this out above on Twitter if you want to take a look. There's some nice pictures. Yeah, go ahead and check out Richard's videos as well from this weekend if you'd like to check out a detailed, well-researched dive into how potentially swaps are working or FTD cycles timing up with maybe some things that happened over the past few years or this summer. Definitely check out Richard's videos from this weekend. I think they, well, I'll say this. I think some of what I have to say complements what he has to say very well. So yeah, so thanks again, everybody, for watching and listening. Have a wonderful day. Good luck out there trading. Good luck out there investing. Let's go GME, and we will see you tomorrow. Thanks very much. Take care.